Texas was supposed to be the unshakable fortress, the last safe haven of American capital. With the absence of state income tax, lands that seemed infinite, and a job market that defied gravity, the state was sold to the world as a risk-free bet. However, as we look at the horizon of 2026, the narrative has changed drastically. The cracks that started to appear years before have transformed into true financial chasms. From the luxurious towers of Austin to the expanding suburbs of Dallas, the Lone Star State is witnessing a historic real estate reversal, something we haven't seen in decades. The hard truth that many real estate agents won't have the courage to tell you is that not every city will survive this tectonic shift in 2026. Inventory is exploding to record levels. Price cuts are ceasing to be a strategy to become an act of desperation, and the enthusiasm of institutional investors is evaporating before our eyes. Here at Keynomics, we don't deal with hopes, we deal with data. And the data points to a perfect storm. In this special dossier, we will reveal the 10 worst cities to buy a house in Texas as we advance into 2026. These are the zones where the market is softening fastest, where equity risk has reached critical levels, and where that so-dreamed Texas dream might cost much more than you imagine. If you take the protection of your assets seriously and want to understand the truth behind the numbers, this is the moment to pay attention. Welcome to Keynomics. Let's get to the facts that matter. We start our risk analysis with number 10, Lubbock. Historically known as the hub city of the High Plains and the proud home of Texas Tech University, Lubbock was once seen by many investors as a hidden gem, a perfect location for stable rentals aimed at students and local families. But as we enter 2026, this college town is quietly coming undone, a victim of its own previous exuberance. What we are seeing here is a classic case of developer miscalculation. Between the years 2021 and 2023, there was an unbridled race to build. Local and out-of-state developers bet big, erecting endless rows of duplexes, apartment complexes, and new subdivisions, anticipating a population growth demand that, unfortunately, never materialized on the projected scale. Now, in 2026, the headline in Lubbock is oversupply. Inventory is dangerously high, creating a saturated market where houses are sitting, gathering digital dust on listing sites for 90, 100 days or more. Price cuts, which were once rare, are now the absolute norm. Builders are being forced to offer aggressive incentive packages, covering closing costs, giving away free appliances, just to move stagnant stock. But Lubbock's problem goes beyond brick and mortar. It is structural. Economic limitation is the Achilles heel for 2026. Outside of the education and health sectors, which are the pillars of the city, the job market is shallow. The technology, finance, and advanced logistics industries, which are driving other Texas markets, simply do not have a significant presence here. For the investor who bought at the peak of the pandemic expecting rapid appreciation, the reality is harsh. Appreciation has stalled. Lubbock isn't collapsing overnight, but it is bleeding value slowly, a steady decline that could trap your capital for years. Moving down the map and up in risk, we reach number 9, Killeen. Anchored by the massive military base Fort Cavazos, formerly known as Fort Hood, Killeen carries a pulsing military history and, for years, was a magnet for those seeking home ownership at affordable prices. It seemed like the perfect equation. Constant military demand plus low prices equals guaranteed profit. However, in 2026, the foundation of this market is shaking violently. Between 2020 and 2022, home prices in Killeen skyrocketed, driven not only by military demand but by out-of-town investors buying properties remotely, blinded by low nominal prices. Today, the bill has come due. Inventory in Killeen has risen more than 50% compared to previous years, creating a sales gridlock. The big red alert for Killeen in 2026 is its singular economic dependence. The city lives and breathes the military base. This creates a binary risk. If troop levels decrease, if federal funding is reallocated, or if deployment patterns change, housing demand can evaporate in the blink of an eye. Furthermore, the city faces chronic infrastructure and service problems. Amenities remain sparse, schools struggle with underfunding, and for investors who bet on the rental market, vacancy rates are rising. The math of 2026 is cruel for Killeen. Those who bought at the peak are seeing their net worth drain, trapped in an asset that isn't appreciating and is difficult to liquidate. Killeen is a market built on fragile ground, and this year is exposing all its vulnerabilities. We advance to the coast, where we find number 8, Corpus Christi. At first glance, Corpus Christi sells a dream: postcard views, Gulf sunsets, and homes just steps from the beach. But, under the analytical lens of Economics for 2026, buying here means assuming massive financial risk. The city is facing what we call a perfect storm of economic stagnation and insurance crisis. This is the critical point no one is discussing enough: insurance premiums. After consecutive tropical threats and the reassessment of climate risks by major insurers, flood and storm insurance costs have exploded. We are seeing beachfront homeowners facing annual bills of $5,000 to $7,000 just to keep their policies. That is, when they can find an insurer willing to cover them. This hidden cost destroys the cash flow of any investment and erodes the purchasing power of locals. Economically, Corpus Christi is also spinning its wheels. Wage growth has stalled, and the city is suffering a brain drain. Young professionals and emerging talents are bypassing Corpus and migrating inland towards San Antonio or Austin in search of better career opportunities. This leaves Corpus with an aging and less skilled buyer market. And we cannot forget the beauty tax. Maintenance on coastal homes is brutal. Salt air corrosion, constant humidity, mold, and storm preparation create a pile of hidden costs that catch many investors by surprise. The new development market has slowed to a crawl, and institutional investors are quietly exiting. Corpus Christi is still beautiful, but in 2026, that beauty comes with a price tag that could drag your finances to the bottom of the sea. Now, we look to the far west, to number 7, El Paso. El Paso is a unique city, culturally rich, visually stunning with its mountains and vibrant border. But financially, it has transformed into a liquidity trap for 2026. The core problem here is extreme geographic isolation. Being over 500 miles from major Texas economic hubs like Houston or Dallas means El Paso operates almost like an island. The city systematically misses out on major corporate expansions and tech investments that feed the rest of the state. The real estate market here is stuck, sputtering in silence. Data for 2026 shows an inventory increase exceeding 60%. We have new construction, resales, and semi-finished developments piling up on the market with few buyers to absorb them. The local economy, while stable thanks to federal agencies, the military, and border logistics, lacks the dynamism needed to generate a sustainable real estate boom. With stagnant local wages and interest rates that still weigh on the average worker's pocket, affordability has become an insurmountable barrier for many. The result is a stagnant market: too much supply, little demand, and little incentive to build or buy. For 2026, the projection is zero appreciation and a significant increase in the time it takes to sell a property. If you are looking for liquidity or rapid capital growth, El Paso is a dead end. Closing the first half of our warning list, we reach number 6, Pasadena. We aren't talking about the celebrity city in California, but rather the hard-working industrial suburb southeast of Houston. Pasadena was once promising, offering affordability for the working class with proximity to the metropolis. But in 2026, Pasadena flashes a giant neon warning: flood risk. The city sits in a low-lying zone, both geographically and, now, financially. Much of the housing stock is mapped directly onto FEMA-designated high-risk zones. After recent storms and hurricanes that severely tested the city's aging drainage infrastructure, buyer confidence plummeted and has not recovered. The impact on the pocketbook is immediate. Insurance premiums in Pasadena are becoming prohibitive, acting as a hidden tax that makes financing unfeasible for first-time buyers. Some homeowners are paying over $6,000 a year just for flood insurance, a cost that destroys monthly affordability. Since mid-2024, home prices in Pasadena have already fallen nearly 9%, and the downward trend is accelerating as we enter 2026. Smart investors have already realized this and shifted their capital to higher, safer ground. What used to be a stepping stone into the Houston real estate market now looks like a dangerous financial liability. Pasadena isn't just struggling, it is sinking under the weight of its environmental risks and rising costs. Number 5 is McAllen. Located on the southern border, McAllen stood out for a long time as a positive anomaly in Texas, culturally vibrant and incredibly affordable for homeownership. During the post-pandemic boom, out-of-state investors flooded the region, speculating that this would be the next growth frontier. But, as we land in 2026, McAllen is facing a harsh economic reality. The buyers have disappeared. Home values have dropped over 10% since the 2023 peak. But the price is merely a symptom. The real disease is the collapse of demand. What we are witnessing in McAllen in 2026 is the creation of a ghost market in certain new developments. Entire subdivisions were built based on speculation, and now the houses remain idle, with streets that look semi-finished and lifeless. Rental yields, which once seemed promising on paper, have dried up completely. Local economic dynamics are also weighing in. Stagnant wages collide with rising utility costs, especially during brutal summers, creating domestic inflationary pressure that drives away first-time buyers. Additionally, healthcare infrastructure and services haven't kept pace with construction. McAllen is becoming an illiquid market. For an investor, illiquidity is worse than depreciation. It means that even if you want to sell at a loss, there is simply no one to buy. In 2026, McAllen is a capital trap where money enters but cannot leave. Heading north, we reach number 4, Fort Worth. Often called the cowboy cousin of Dallas, Fort Worth possesses grit, charm, and a strong identity of its own. For years, it prospered quietly in the shadow of its flashier neighbor, building its own real estate empire with enviable stability. But developers committed the cardinal sin of real estate: greed. They built too much, and they built too fast. In 2026, the Fort Worth empire is showing deep structural cracks. The scenario in Fort Worth is defined by a deluge of supply. We have planned suburbs, high-rise apartments, and sprawling condos flooding the market simultaneously. Supply is drowning demand, and prices are paying the price. The average time a house stays on the market has doubled since 2022. Price cuts have become routine, and properties that were once fought over in hours now sit for months. But there is an even darker indicator emerging in Fort Worth in 2026: foreclosures. While not yet a giant wave, the number of foreclosure filings is growing, a clear sign of deep financial stress among middle-class buyers who over-leveraged themselves in previous years. Add to this the problems of disorderly growth, delays in trash collection, pothole-ridden roads, and overburdened school districts, and you see buyer confidence unraveling. Fort Worth isn't collapsing, but the foundation is shaky. The growth it chased so hard has now caught up with it, and 2026 is the hangover year. Now, we enter fool's gold territory with number 3, Frisco. For years, Frisco was the absolute darling of the Texas real estate market. It was the suburb exploding with promises: luxury planned communities, gleaming corporate headquarters, top-tier schools. But in 2026, that promise is cracking under its own weight. Frisco has become living proof that luxury markets are the first to bleed when the economy tightens. Inventory here has skyrocketed, rising nearly 80% compared to the previous year. What we are seeing in Frisco is the bursting of a luxury bubble. High-end builds that once provoked bidding wars are now idle. Developers are cutting prices by $30,000, $50,000, or even more, and offering interest rate buy-downs. But not even that is enough to attract cautious buyers. Behind the shiny facade, the infrastructure is groaning. Traffic congestion has reached critical levels, school enrollments are overflowing, and HOA fees and property taxes are soaring, eroding monthly affordability. For investors, the short-term rental market has evaporated, and those who bought in 2022 are already underwater, owing more than the house is worth. Frisco still looks polished on the outside, but financially, the numbers for 2026 no longer make sense. It's a market where you pay for prestige but lose on equity. We arrive at the runner-up of our risk list, and it's a name that will shock many who don't follow the data closely. Number 2, Austin. The fall of a giant. Austin was the tech darling, the migration magnet, the gold rush of the pandemic era. From 2020 to 2022, Austin was untouchable. But in 2026, the city has become financially unviable for the average investor. Austin isn't just cooling, it is contracting violently. Home values have plummeted over 15% to 20% in many zip codes, and the drop hasn't found the bottom yet. Entire condo towers in the downtown area go dark at night, silent monuments to speculative excess. What happened? The tech exodus and the remote work correction. Layoffs and restructuring at giants like Google, Meta, and Oracle cut the high-income demand that sustained inflated prices. Distant suburbs, which relied on commuting workers, are losing steam rapidly. Furthermore, restrictions on Airbnb and short-term rentals crushed the profits of investors counting on tourism. Austin suffered from hubris, excessive pride. Builders overestimated demand by a mile, and now the market is drowning in oversupply, dragging prices down across all sectors. If you are buying in Austin in 2026, Do it strictly for the lifestyle, because the ROI, return on investment, has evaporated. Austin is the lesson of 2026. What goes up too fast comes down with the same speed. And finally, we reach the top, the riskiest city, the most dangerous market for your money in Texas in 2026. Number 1, San Antonio. Many expected Austin at the top, but San Antonio takes the unwanted crown for a simple and terrifying reason: the sheer volume of unsold inventory. San Antonio is a city rich in history and culture, but in recent years, it has become a victim of housing hyperbole. The city grew too fast. Developers rushed to build in every direction, from Cibolo to New Braunfels, creating a massive surplus of new homes that the local market simply cannot absorb. In 2026, San Antonio is one of the major urban centers in America, where new listings outnumber actual sales by a historic margin. It is a flood. Prices are slipping, and builders are entering panic mode, offering free upgrades, aggressive discounts, and desperate incentives just to maintain some sales volume. But the demand isn't there. Meanwhile, current homeowners face their own nightmares. HOA complaints are rising, utility cost spikes are hitting family budgets, and quality control issues in rushed construction, cracked foundations, HVAC failures, are pushing buyers to the edge. Add to that rising crime in certain districts and job creation that, outside the healthcare sector, remains stagnant, and you have the recipe for an investment disaster. San Antonio isn't just stagnant, it is bloated, overpriced, and oversupplied. Even owner-occupants, the backbone of any stable market, are starting to question their decisions. San Antonio is the number 1 market to avoid in 2026 because the fundamental math of supply and demand here is more broken than anywhere else in the state. Texas isn't falling off the map. It is a resilient state with a diversified economy. But these 10 cities we covered today are flashing red warning lights in plain sight. High inventory, declining demand, hidden climate risks, and rising taxes are the new reality of 2026. The market has changed. The easy money party is over. If you don't dig deeper, if you don't look beyond the glossy brochures and the realtor's promises, your dream home can quickly turn into a financial nightmare. That is why we are here at Keynomics. We break down the changing real estate markets of America with truth, proprietary data, and zero hype. Our goal isn't to scare you, it is to prepare you. If you value your wealth, click the subscribe button. Share this dossier with someone thinking about buying in Texas. Let's make smarter moves together.